Reading 57, Basics of Derivative Pricing and Valuation. The candidate should be able to explain how the concept of arbitrage, replication, and risk neutrality are used in pricing derivatives, distinguish between value and price of forward futures contracts, explain how the value of price of a forward contract are determined at expiration during the life of the contract, and at initiation describe monetary and non-monetary benefits and costs associated with holding the underlying asset, and explain how they affect the value and price of a future contract, define a forward rate agreement and describe its use, explain why forward and future prices differ, explain how swap contracts are similar but different from series of forward contracts, distinguish between the value and price of a swap, explain how value of a European option is determined at expiration, explain the exercise value, time value, and moneyness of an option, identify the factors that determine the value of an option, and explain how each factor affects the value of an option, explain put-call parity for European options, explain put-call forward parity for European options, explain how the value of an option is determined using one period binomial model, explain under which circumstances the values of European and American options differ. Introduction: it is important to understand how prices are derived of derivatives are determined, whether one is on the buy side or the sell side. A solid understanding of pricing of financial products is critical to effective investment decision making. After all, one can hardly determine what to offer or bid for financial products, or any products for that matter, if one has no idea how to calculate the characteristics combined to create value. Understanding the pricing of financial assets is important. Discounted cash flow models such as the capital asset pricing model and various are useful for determining the prices of financial assets. A unique characteristic The unique characteristics of derivatives, however prone such complexities, are not associated with assets, such as equities and fixed income instruments. Somewhat surprisingly, however, derivatives also have some simplifying characteristics. For example, as we will see in this reading, in a well-functioning derivative market, the need to determine risk premiums is obviated by the ability to to construct a risk-free hedge. Correspondingly, the need to determine an investor's risk aversion is irrelevant for derivative pricing, although it is certainly relevant for pricing the underlying. The purpose of this reading is to establish the foundations of derivative pricing. On a basic conceptual level, the following topics are covered. How does pricing of the underlying asset affect the pricing of derivatives? How are derivatives priced using the principle of arbitrage? How are the prices and values of forward contracts determined? How are future contracts priced differently from forward contracts? How are the prices and values of swaps determined? How are the prices and the values of European options determined? How does American option pricing differ from European option pricing? This reading is okay, so that's how the reading is organized. Fundamental concepts of derivative pricing. In this section, we will briefly review the concepts associated with derivatives, the types of derivatives, and the pricing principles of the underlying asset. We will also look at arbitrage, a critical concept that links derivative pricing with the price of the underlying, the basic derivative concept. Once again, the derivative is a financial instrument that derives its performance from the performance of an underlying asset. A derivative is created as a contract between two parties, the buyer and the seller. Derivatives trade in markets around the world, which includes organized exchanges, where highly standardized and regulated versions exist. On the and over-the-counter markets, they're customized and more lightly regulated versions trade. The basic characteristics of derivatives that influence pricing. and not particularly related to where the derivatives trade, but are critically dependent on the types of the derivatives. The two principal types of derivatives are forward commitment and contingent claims. The forward commitment is the obligation that to engage in the transaction in the spot market at a future date at terms agreed upon today. By entering into a forward commitment, a party locks in the terms of the transaction that he or she will conduct later. When the commitment is critical here. A forward contract is the over-the-counter derivative contract in which two parties agree to one party. The buyer will purchase the underlying asset upon the seller, at a later date at a fixed price they agree upon. When the contract is signed, the futures contract is a standardized derivative contract created and traded on a futures exchange in which two parties agree that one party, the buyer, will purchase the underlying asset from the other party, the seller, at a later date at a price agreed upon by the two parties. When the contract is initiated and in which there is a daily settling of gains and losses on the credit guarantee by the future exchange through its clearinghouse. A swap contract is an over-the-counter derivative contract in which two parties agree to exchange a series of cash flows whereby one party pays a variable series that will be determined by an underlying asset or rate, and the other party pays either a variable series determined by the different underlying asset rate or a fixed series. An option is a derivative contract in which one party, the buyer, pays a sum of money to the other party, the seller or writer, and receives the right to either buy or sell an underlying asset at a fixed price, either on a specified specific expiration date or at any time prior to the expiration date. Options can either be customized, over-the-counter contracts, standardized, and traded on the exchange. Pricing the underlying. The four main types of underlyings of which derivatives based are equities, fixed income securities, interest rates, currencies, commodities. Equities, fixed income securities, but not interest rates. Currencies and commodities are all assets, and an interest rate is not an asset, but it can be securitized as the underlying of a derivative. Consider a generic underlying asset. The asset is something of a value that you can own. Some assets are financial assets such as equities, bonds, and currencies, and some are real assets such as commodities or such as gold, agricultural products, certain physical objects such as cars, houses, computers. The price of financial assets is often determined using a present value of a future cash flow approaches. The value of its financial assets is the expected future price plus any interim payments such as dividends or coupon interest discounted at a rate appropriate for the risk assumed. Such a definition presumes a period of time over which an investor anticipates holding an asset, known as the holding period. The investor. Okay. Normal distribution curve. Okay. The principles of arbitrage. Arbitrage is the type of transaction undertaken when two assets or portfolios produce identical results but sell for different prices. If a trader buys the asset or portfolio at a cheaper price and sells it at a more expensive price, she would generate a net inflow or funds at the start. because the two assets or portfolios produce identical results, a long position and one of these short positions in the other means that are the end of the holding period, the payoff offsets, hence no money is gained or lost at the end of the holding period, so there is no risk. The net effect of the arbitrage receives money at the start and will never have and never has to pay out that money later, since such a situation amounts to free money, like walking down a street, finding money on the ground, and never having to give it up. Okay. Arbitrage and derivatives. It may be difficult to conceive in many investments that would produce identical payoffs. Even similar companies such as McDonald's and Burger King, which are in the same line of business, do not perform identically. Their performance may be correlated, but each has its own unique characteristics. For equity securities, and which no derivative involved. But the one such situation that could exist in reality is a stock that trades simultaneously in two different markets, which trades in Amsterdam and London, but in a single company. Currently, they can be only one price. If these two markets operate in different currencies, the currency adjusted price should be the same. Bonds issued by the same borrower are also potentially arbitrageable. Arbitrage and replication, because a long asset and a short derivative on the asset can be combined to produce a position equivalent to a risk-free bond. It follows that the long asset and a short risk-free asset can be combined to produce a long derivative. Alternatively, a short derivative and a short risk-free asset can be combined to produce a short asset position. Exhibit 6 shows the process referred to as replication. Replication is the creation of an asset or portfolio from another asset, portfolio, and or derivative. Risk aversion, risk neutrality, and risk arbitrage pricing. Most investors are risk adverse. They do not accept risk with expectations of a risk commensurate with the risk. Thus, the required risk premium to justify the risk. One may think that the point implies a method for pricing derivatives based on anticipation of risk premiums to the expected payoff of the derivative and its risk. As we will describe later, this methodology is not appropriate in pricing and the pricing of derivatives. As previously described, a derivative can be combined with an asset to produce a risk-free position. This fact does not mean that we should create such a combination. It merely means we can do so. The derivative price is the price that guarantees the risk-free combination of a derivative and the underlying produces a risk-free return. The derivative price can then be inferred from the characteristics of the underlying, the characteristic of the derivative, and a risk-free rate. Limits to arbitrage. As we previously described, there may be reasons to not pick a coin lying on the ground. Likewise, some arbitrage profits can never be exploited. A bond selling for €100 may offer the arbitrage profit of trading derivative, but the bond at a risk-free asset at a total cost of $9.99. Cost of 99 could be the profit of 1 might exceed by the transactional cost. Such small differences can easily remain essentially trapped within the bonds of transaction costs. Indeed, in addition, arbitrage can require capital. Not everyone can borrow virtually unlimited amounts of money at what amounts to risk-free rates. The concept of pricing versus valuation in equity markets. Analysts and underlying with the objective of determining the value, sometimes called the fundamental value of a stock, When a stock trades in the market for a price that differs from the fundamental value, investors will often buy or sell the stock based on the perceived mispricing. The fundamental value of the stock, typically determined by analyzing the company's financial statements, projecting its earnings and dividends, determining a discount rate based on the risk, and finding the present value of the future dividend. These steps make up the essence of dividend discount models. Other approaches include comparing the book value of a company and its market value, thereby using book value as a proxy for fundamental value, or by application of price/earning ratios to projected next period earnings, or by discounting free cash flows. Each of these approaches purports to estimate the company's fundamental value, leading to a notion of a company's is worth something that may or may not correspond to the price in the market. Pricing and valuation of forward commitments. In this section, we will go into pricing forward commitments, and in a little more detail, let us start by establishing that today, at time 0, we created a forward commitment that expires at time t, the value of the underlying asset. Okay, so that's just the preposition. Pricing and valuation of forward contracts. Previously, we noted that the price of and value are entirely different concepts. For forward commitments, we give an example of a forward contract with a price of 100 but a value of 5.85, and a seller of plus 5.85 to the buyer. In the next subsection, we will delve more deeply into understanding these concepts and pricing the valuation for more forward contracts. Okay. This reading on derivatives pricing provides a foundation for underlying how derivatives are valued and traded. Key points include the following. The price of an underlying asset is equal to the expected future price discounted at the risk-free rate, plus a risk premium, plus the present value of any benefits, minus the present value of any costs associated with holding the asset. An arbitrage opportunity occurs when two identical assets or combinations of assets sell at different prices, leading to the possibility of buyers and cheaper assets and selling the more expensive asset to produce a risk-free return without investing any capital. In well-functioning markets, arbitrage opportunities are quickly exploited, and the resulting increased buying and unpriced asset and increased selling of overpriced assets return prices to equivalence. Derivatives are priced by creating a risk-free combination of the underlying and a derivative, leading to a unique derivative price that eliminates any possibility of arbitrage. Derivative pricing through arbitrage precludes any need for determining risk premiums or the risk aversion of the party trading an option, is referred to at risk neutral pricing. The value of a forward contract at expiration is the value of the asset minus the forward price. The value of a forward contract prior to expiration is the value of the asset minus the present value of the forward price. The forward price established with the contract is initiated is the price agreed to by the two parties. That produces a zero value at the start. Costs incurred and benefits received by holding the underlying affects the forward pricing by forward price by rising and lowering it respectively. Futures prices can differ from forward prices because of the effect of interest rates on the interim cash flow from the daily settlement. Swaps can be priced at implicit series of off-market forward contracts whereby each contract is priced the same, resulting in some contracts being positively valued and some negatively valued, by which their combined value equals zero. At expiration, a European call or put is worth its exercise value, which for call is the greater of zero, or the underlying price minus the exercise price, and for puts the greater than zero than the exercise price minus the underlying price. European calls and puts are affected by the value of their underlying, the exercise price, the risk-free rate, and the time of expiration, the volatility of underlying, and the cost of incurred or benefits received while holding the underlying. Operations values experience time value decay, which is the loss in value due to the passage of time, and the approach of expiration plus the moneyness and the volatility. The minimum value of a European call is the maximum of zero, and the underlying price minus the present value of the exercise price. The minimum value of a European put is the maximum of the zero, and the present value of the exercise price minus the price of the underlying. European put and call prices are related through a put-call forward parity, which shows that the put price plus the value of the risk-free bond and the face value equals to the forward price equals to the call price plus the value of the risk-free bond with face value equal to the exercise price. The value of a European options can be obtained using the binomial model, which specifies two possible prices of the asset one period later and enables the construction of a risk-free hedge consisting of an option of the underlying. American call prices can differ from European calls prices only if there are cash flows on underlying such as dividends or interests. These cash flows are the only reason for early exercise of a call. American put prices can differ from European put prices because the right to exercise early always has value for a put, which is better than lower limits on the value of the underlying. And thus is reading 57 of the CFA Level 1 program curriculum. I do hope my readings have been helpful, and I hope to see you guys next time. Goodbye.